Peace and love, good people. Peace and love. Welcome back. A lot of people want to discuss or ask me questions about the lines on my chart. I don't use a ton of indicators. I don't use a ton of, I don't use much of anything. Trend lines. I mainly do horizontal lines that represent key levels of support and resistance, and moving averages. Those in combination with price action and volume. All right, so let's start with moving averages as we break down the key components to my most successful trades. All right, so a moving average is the average of the closing price of an asset over a specified period. As its name implies, it moves as it is constantly updated according to the latest closing price. A moving average appears smoother than a price line by reducing the impact of short-term price fluctuations, thus giving a clearer picture of market trends. Okay, now listen. Moving averages can be used to identify trend direction or define potential support and resistance levels. All right, we're going to keep this elementary minded. Okay, keep this elementary minded. All right, middle school minded. All right, so there's a few types of moving averages. All right, the two types of moving averages are the simple moving average, the MA, and the exponential moving average, the EMA. All right, so from what I understand, the simple moving average is your basic mean. Everybody from grade school, raise your hand if you went to middle school. So you might not remember, but they did talk to you about the mean, median, and the mode in middle school. And the mean is the average. So you take the total number of items you have or numbers you have, you add them up and you divide them by that number. So if you got 5 numbers, you add them all up together and you divide them by 5, and that is the mean. That is your average. Okay, that is what the MA does. Now the EMA, let's say you have 10 numbers. The EMA, the exponential moving average, is gonna assign some extra weight to the more recent numbers in your line, in your trend line, or in your number line. All right, so if you have 10 items, maybe all of them are valued at 8, and then the last 2 might be valued at 14, or whatever it is, however you get to the total number of 100%. All right, so the exponential moving average is more likely to be closer to the most recent data. All right, but at the end of the day, the way we use it, it's not making a drastic difference. So whatever floats your boat. Now, according to Webull here, a simple moving average is calculated giving equal weight to each price. For example, data points of a 5-day moving average is computed as the sum of the closing price from the previous 5 trading days divided by 5. However, an exponential moving average gives more weight to the latest prices. This makes EMAs more sensitive to new price change than the MA. Length of moving averages. Moving averages are customizable. You can customize the length according to your needs. For example, a 5-day moving average is usually used to represent short-term momentum. 20-day and 60-day moving averages are indicators of intermediate trends. All right, so we're looking at, this is basically talking about a daily time frame. So if you're looking at the daily time frame, 5 candles are going to represent the last 5 days. And if you put a moving average on it, the moving average is going to represent the average price of the stock over those 5 days. Now, when you're looking at a daily time frame, looking at a short-term move, you're going to leverage the current price and the moving averages, and you're going to be looking more at the last 5 candles on a daily time frame, which is going to basically represent the previous week. And then if you're looking for a longer term situation, you'll be looking at 20 to 60 candles. All right. That's going to give you about a month's worth of data to 1 to 3 months. All right. So anything beyond that, I'm unfamiliar with. All right. So there is no best moving average length. You can explore different lengths so that it can signal future trends better. All right. So from my brief experience, I understand that the 200 period moving average is extremely powerful and common, and oftentimes it can be used similar to, everybody's using the indicator, the VWAP, the volume weighted average price. That's about the same as the 200 period moving average. So I typically use that. I don't use the VWAP in my trading. And then the 20 period moving average is great for identifying trends on the smaller time frames specifically. And then obviously the 48. So we're using the 200, the 48, the 20, the 13, and the 8. All right. Now, sometimes we might have them all on. I normally have them all on my chart, but you could very well just put a couple of them up there. It's totally up to you. All right. Now, what does a moving average imply? Generally speaking, if the price is above the moving average, the asset is in an uptrend. If the price is below the moving average, the asset is in a downtrend. Pretty simply put. Moving averages can be identified as a support or a resistance level. All right. So again, I like to think about moving averages as missiles coming across your screen, interfering with the movement up or down. All right. Moving averages, when the price moves up and breaks through the moving average line can be identified as a support level. Again, when you break through the roof becomes the floor. When you break through the floor, the floor becomes the roof. This is not any different. All right. You just have to hear it over and over and over and over again until it clicks. And then when this piece clicks, the next piece will click. And then one day it'll all come together. All right. When the price drops below the moving average line becomes a resistance level. Just what I said. The breach points are possible price reversal signals. All right. So we're playing support and resistance, and we're looking to ride the whole way up. That first 5 minutes of the day, we kind of scalping we're going to take advantage of any quick, violent moves in any direction, whether we're at resistance, support, or in the middle. But once the day really gets going and we can identify a bottom, we want to jump in there and ride that thing all the way to the top. Or if we realize that it has hit resistance and it is bouncing back down after being tested once or twice, we're going to buy a put, and we're going to ride that all the way back down with confidence. All right. So that's the game plan for next week for sure. All right. When a short-term moving average moves upward and crosses the longer-term moving average, it is considered as a bullish signal. So when a 20-period moving average moves upward and crosses the 200-period moving average, it's considered bullish. The crossover is called a bullish crossover. Investors may want to buy at this point. When a short-term moving average, like the 13-period moving average, drops beneath the longer-term moving average, like a 48-period moving average, it is considered as a bearish signal. The crossover is called a bearish crossover. Investors may want to sell at this point. All right, keep that in mind. So we have the golden cross and the death cross. The golden cross and death cross are believed to have great significance. A golden cross implies a long-term bull market, while a death cross signals a long-term bear market. Many technical analysts use 50-day moving averages and 200-day moving averages to identify long-term trends. The crossover signals identified is called either a golden cross or a death cross. As we learned above, the crossover is as we learned above, when the short-term 50-day moving average moves upward and crosses the 200, this is bullish. The crossover is called the golden cross. In contrast, when the 50-day average drops beneath the 200-day average, this is a bearish signal. The crossover is called the death cross. So this is crucial for you to really understand what's being said here. We are looking at the daily time frame. So this explanation is based on the daily time frame. It can be applicable to smaller ones, but when we're talking about the golden cross or the death cross, when we're talking about whether or not we are in a long-term bull market or a long-term bear market, we want to know if the 50-period moving average crosses beneath the 200-day moving average. All right, that's what we want to look at. Get a heads up when technical signals appear. Watching prices can be time consuming. Okay, that's an ad. I'm bugging out, about to read that for no reason. All right, so what's going on? I want you to take this information back to your chart. I want you to go sit back down at your desk, look at your chart. All right, go to your favorite stock. Matter of fact, go to the SPY, go to the S&P 500. All right, that's the stock market. So go to the S&P 500, go to SPY, and Robinhood, type in SPY, and with Webull, type in SPY. All right, and look on the daily time frame. Go to your moving averages. Turn your 50-period moving average on. Turn your 200-period moving average on. And let's look at it. Let's see if we see the 50-period moving average crossing beneath the 200-period moving average on the daily time frame. This crossover is called the death cross, which is a symbol. It implies that we'll be in this bear market for a very long time. Peace and love, good people, and I hope you get rich. Please subscribe to the channel, comment down below, leave a like. Let's get this video to 100 likes. I need y'all help. I need to get 1,000 subscribers. I want to keep cooking. I need a bigger audience. I need more people in the room. So share this video, share with a friend. I really appreciate your time. Thank you for being here. Peace and love, and I'll see you in the next video.